Wow, what a week. Amazon and Apple reported their Q3 earnings. Spoiler alert, they both crushed it. That's a big deal for us, as those companies make up about 10% of our portfolio, and they're companies we'll continue to invest in. A lot of investors say that tech is one of the safest places to invest right now, and these earnings reports show why. They have proven resilient, even successful, in this pandemic environment. Big tech was also brought in to speak in front of Congress. That's something we'll touch on. And we'll look at the portfolio's performance so far and invest another $100. I've got a new company to add that I'm really excited about. Let's get started. Welcome to Get Invested, where we talk about money, discipline, and business strategy. In this series, I'm demonstrating how I build market-beating stock portfolios using a growth-focused mindset, starting with just $100. I invested $100 on July 1st of this year, and I'm continuing to invest another $100 each week, every Tuesday, here on YouTube. I share my trades for you to see, with a little bit of my thinking and rationale along the way. Direct links to the portfolio can be found in the video description below. If any of that sounds interesting to you, hit that like and subscribe button. It really helps out new channels like this one. So let's take a look at the portfolio. It currently sits at $534.83. It's a total gain of $35.86, a return of 11.71%. Those of you following the series know that this is quite an impressive jump over last week, where we were only up about 2%. Let's look at this chart to see our historical performance. This chart tracks our portfolio's return on investment benchmarked against the Dow and the NASDAQ. Here you can see back on July 28th, we were only up 2.23%. This happened when there was a sharp sell-off in the tech sector. That's why you can also see a dip in the NASDAQ. And our portfolio was overexposed to our highly speculative EV and automotive stocks, Tesla and NIO, right when both of them experienced a sharp sell-off as well. This highlighted a clear vulnerability in the allocations of our portfolio, and we made adjustments last episode. You can now see those adjustments paying off quite well, as we're now up 9 percentage points on last week's performance. Going further, this chart highlights our portfolio's monetary value split between unrealized gains and our investments to date. You can see that last week we were only up about $4.48 on the $400 we invested. But this week, after investing a total of $500, we're up $35.86. Currently, that's the most gains we've seen so far. Keeping our fingers crossed that this trend just continues. Now let's talk about this week's news. So it's earnings season, and this one's an important one because it includes recovery during the pandemic. First, we have Amazon. Wall Street had high expectations for this company. See, we're in a pandemic with ongoing regional lockdowns, so consumers and businesses relied on Amazon's e-commerce and web service offerings an increasing amount during this period. Well, Amazon delivered with a 40% increase in year-over-year earnings. That's a 43% increase in US sales and a 38% increase internationally. Amazon's ability to beat expectations just shows that investors are still undervaluing the company's ability to perform at scale. Then there's Apple. Their revenue was up 11% year over year. iPhone sales actually beat Wall Street's expectations as well, all during widespread global retail store closures. What people missed here is that in a world of remote work and at-home learning, a MacBook, an iPad, and an iPhone are actually considered productivity tools, not just toys or entertainment. I also think people make the mistake of thinking of Apple as just a hardware company. They also have the App Store and iTunes, two business services that aren't really affected by a pandemic. Then there's Alphabet, also known as Google. They actually beat earnings expectations with an EPS of $10.21 versus the expected $7.92. However, their quarterly revenue actually declined year over year for the first time in company history. It declined about 2%. And that's mostly because they're an advertising company at their core, and a lot of businesses have been forced to tighten advertising spending as a reaction to the pandemic's impact on our economy. So while Google may have underperformed their own expectations, they still beat the market's expectations, which is great and also shows the resiliency of these businesses. Even in downtimes, they are still outperforming expectations. When I first got into investing, I thought owning individual stocks was a risky strategy. But this is showing me that when you own stock in good businesses, the downside risk isn't as bad as we imagine it to be. In other related news, Big Tech was brought to testify in front of Congress last week. Now, this is a probe hearing where Congress gets to go on record taking public stances on the matter. If this really gains momentum, I'll do another video on it. For now, I just want to share Jeff Bezos' response at this testimony. I think it's a masterclass in corporate leadership.
Mr. Bezos, you may begin.
Thank you, Chairman Cicilline, Ranking Member Sensenbrenner, and members of the subcommittee. I was born into great wealth, not monetary wealth, but instead the wealth of a loving family, a family that fostered my curiosity and encouraged me to dream big. My mom, Jackie, had me when she was a 17-year-old high school student in Albuquerque. Being pregnant in high school was not popular. The school tried to kick her out, but she was allowed to finish after my grandfather negotiated terms with the principal. She couldn't have a locker, no extracurriculars, and couldn't walk across the stage to get her diploma. She graduated and was determined to continue her education, so she enrolled in night school, bringing me, her infant son, to class with her throughout. My dad's name is Miguel. He adopted me when I was 4. He was 16 when he came to the U.S. from Cuba by himself shortly after Castro took over. My dad didn't speak English, and he did not have an easy path. What he did have was grit and determination. He received a scholarship to college in Albuquerque, which is where he met my mom. Together with my grandparents, these hardworking, resourceful, and loving people made me who I am. I walked away from a steady job on Wall Street into a Seattle garage to found Amazon, fully understanding that it might not work. It feels like just yesterday I was driving the packages to the post office myself, dreaming that one day we might afford a forklift. Customer obsession has driven our success, and I take it as an article of faith that customers notice when you do the right thing. You earn trust slowly, over time, by doing hard things well, delivering on time, offering everyday low prices, making promises and keeping them, and making principled decisions, even when they are unpopular. And our approach is working. 80% of Americans have a favorable impression of Amazon overall. Who do Americans trust more than Amazon to do the right thing? Only their doctors and the military. The retail market we participate in is extraordinarily large and competitive. Amazon accounts for less than 1% of the $25 trillion global retail market and less than 4% of US retail. There's room in retail for multiple winners. We compete against large established players like Target, Costco, Kroger, and of course, Walmart, a company more than twice Amazon's size. 20 years ago, we made the decision to invite other sellers to sell in our store to share the same valuable real estate we spent billions to build, market, and maintain. We believe that combining the strengths of Amazon's store with the vast selection of products offered by third parties would be a better experience for customers, and that the growing pie of revenue and profits would be big enough for all. We were betting that it was not a zero-sum game. Fortunately, we were right. There are now 1.7 million small and medium-sized businesses selling on Amazon. The trust customers put in us every day has allowed Amazon to create more jobs in the United States over the past decade than any other company. Hundreds of thousands of jobs across 42 states. Amazon employees make a minimum of $15 an hour, more than double the federal minimum wage. And we offer the best benefits that include comprehensive health insurance, 401k retirement, and parental leave, which includes 20 weeks of paid maternity leave. More than any place on earth, entrepreneurial companies start, grow, and thrive here in the US. We nurture entrepreneurs and startups with stable rule of law, the finest university system in the world, the freedom of democracy, and a deeply accepted culture of risk-taking. Of course, this great nation of ours is far from perfect. Even as we remember Congressman John Lewis and honor his legacy, we're in the middle of a much-needed race reckoning. We also face the challenges of climate change and income inequality, and we're stumbling through the crisis of a global pandemic. Still, with all of our faults and problems, the rest of the world would love even the tiniest sip of the elixir we have here in the US. Immigrants like my dad see what a treasure this country is. They have perspective and often can see it even more clearly than those of us who were lucky enough to be born here. It is still day one for this country, and even in the face of today's humbling challenges, I have never been more optimistic about our future. I appreciate the opportunity to appear before you today, and I'm very happy to take your questions.
You just watched the richest man in the world position himself as a relatable personification of the American dream. And his $1.5 trillion company is the quintessential American business. I don't know many people who can watch that clip and not want to apply to work at Amazon right now. See, good leaders know how to connect with people, empathize with them, and then get people to rally behind them. These are the types of leaders I look for, whether it's a job I'm going to work at or a company I'm going to invest in. And that brings me to this week's newest addition to the portfolio. Anyone who's been following closely may have noticed that the healthcare portion of our portfolio is performing exceptionally well. In just 1 month's time, it's up over 23%. That's almost double our investments in big tech. Healthcare is really hot at the moment. A lot of investors and analysts are saying that this pandemic situation is causing an acceleration in adoption of new technologies and innovation. And we're seeing that play out in the healthcare space. For that reason, I think it's important for us to seek out other companies that are leading growth in that area. So I want to introduce you to Livongo Health. And I could explain what they do as a business, but I think it's important for you to hear it from their founder and CEO. Check out this clip.
When you think about healthcare today, it's all about chronic conditions. It's 90% of all the cost are chronic conditions. 90% of all the costs in healthcare are related to chronic conditions. No, they don't. And we are still stuck with an acute care system.
Right.
So Livongo was about how do we empower people with chronic conditions to live better and healthier lives, just like you were saying. And that's what we do. We use connected devices. We use a lot of data science, change people's behavior, and get better results. So now, it's a simple formula. Basically, what we've done is we've made it easier to stay healthy. Okay. And, you know, the problem with healthcare is that people have tried to bribe people instead of saying, let's create a valuable service that people actually want to use.
Right.
And if you think about how the economy's been organized, Google came along and it said you can get information 24/7.
Right.
Facebook came along and they organized content. Facebook came along and organized community. 24/7, you can find where somebody is, their high school buddies or not. And then Amazon came along, 24/7, right at your fingertips. You're empowered, you're in charge. So you had content, you had community, you had commerce, and now Livongo is doing it for care. 24/7, connected, providing you with the information, putting you back in charge.
So what do the companies think about this when they bring you in?
Well, companies love it because we do three things that matter. One, their people love it, our members, they really love it. Our net promoter score is in the mid-60s in an industry where 0 is good.
I know.
Second, we're able to actually show outcomes, clinical, sustainable outcomes. We improve their health. And last but not least, and the companies really like this, we save money. So almost $1,900 annually per person with diabetes or other chronic conditions. And the beauty of it is now 20% of our revenues are coming from our other, we started in diabetes, we built trust, we added a few 100,000 people, and then we branched out because here's an interesting stat. 70% of the people with type 2 diabetes have hypertension. So talk about an easy jump.
Okay.
Now we go to hypertension. 70% of those folks have a weight management challenge. And then you go to behavioral health. So now you've described the platform that makes it easier for companies to make the decision to keep their people healthy.
So we have a young healthcare company positioning themselves to scale like Amazon in the massive chronic healthcare conditions market and gaining traction in ways big tech companies haven't yet. I want to remind you, boomers, a large portion of our population, are currently entering this very market. And their product is designed to help improve people's lives in a tangible way, not just through empty consumerism. It's hard for me not to get excited about making an investment in this business. It's exactly the type of company I would want to own a portion of. And I'm not the only one. Their stock price has been surging these last 6 months. So it's time for us to get in now. It will be a long time hold. So like our other stocks, we will continue building out our position over time to smooth out short-term price fluctuations. But I'm really excited about this one. And here we have Livongo Health added to the healthcare portion of our portfolio. Looking at the other healthcare companies and how well they have performed, I feel relatively confident buying a decent amount of Livongo today. Not so much we weight it over Teladoc or Quidel, but why don't we just do it right in the middle? So for Livongo Health, we're going to invest $60 today. Great, that's all set. And in the meantime, what are we going to do with the other $40? Well, technology seems to be doing well. I foresee probably a little dip as many other investors sell off after earnings period. So I don't think we want to buy into technology right now. But a great place to buy in is our other consumer stocks. We know Netflix already did a bit of underperformance, so they're probably priced pretty well right now. And McCormick is still going strong. So I'm going to put the other $40 directly into this portfolio. Our trades are all queued up. We've got $60 of Livongo, $28 in Netflix, and $11 in McCormick. That's it for this episode. Make sure to check in next week and see how we do. If you found this video interesting, hit the like button. Also, feel free to share your thoughts in the comments. If you want to join us on this investing adventure, hit the subscribe button. We'd love to have you. Links to this episode's portfolio are in the description below. And if you want to get notified each time we add a new video or new stocks, make sure to hit that notification bell. Thanks a lot. Have a good week. Stay safe and get invested.